That's because, number one, we give money regularly, which is our premium, right? Uh, they invest that money on returns and grow rich out of that, out of our money. We see nothing and everything operates behind the doors just like a bank does. They pay out minimum possible, which keeps system complex and confusing. Now, my goal is to help you learn and understand this concept of invisible bankers and help expose this hidden world of insurance, right? And how to use insurance wisely instead of being exploited by it, right? So, part one is how insurance really works. That is going to be the main thing, right? What is insurance, right? We need to understand. First of all, insurance is basically a gambling business. Now, hear me out. I know this might seem a little bit cliche. First of all, whenever we bet something, whenever we invest somewhere, we bet that we will face a loss, right? Whenever we take a car insurance, we bet that we will face a loss, right? And the insurance company bets that you won't face a loss, right? You put money towards a bet where you say, I will face a loss. Insurance company says you won't face a loss, right? Now, you might think, well, what are you saying? Insurance companies are there to pay for your car when the accident happens, right? No, that is not why insurance companies are there for. They are there to bet that you won't meet an accident. We always pay, and they might pay. And the house, which is the company, the insurance company is the one who sets the rules. We don't set any rules, we just accept the rules. So basically, it's the insurance company that wins over the long run. Why? Because number one, we always pay, they might pay, right? The other thing is, they set rules, we only follow. Third thing is, they win over long run. That is how it works. That is basically what insurance is. Now, basically, companies or these insurance companies, what do they do is they create risk pools where many people pay premium, only a few of them make claims, and the company pockets the difference. That's basically how it works. So many people know this, but I'm just here to reiterate it to you. Now, why are premiums higher? That's the question, right? So, where does your premium actually go down, right? So, normally, whenever a company makes, let's say they make $100,000 in premiums, right? Out of that, they have to spend about 55% to 65% on claims, right? Then they have to pay on salaries and expenses. They have to spend about 15 to 20%. They have insurance agent commissions, sales commissions, which is about 10 to 15%. Then there is profit plus investment gains, which is about 3 to 10%, right? Now, the meaning of this is the huge part of what you pay is not for your protection, it's for running the giant business, right? So, about 50% of the money that you spend is gone towards running the company, right? That's why we don't need to buy lots of insurance product. It doesn't mean that we should not buy insurance product. We should buy, but there should be a strategy on how we buy this. That is what we are here to understand. Now let's talk about part two, which is tricks and traps of insurance companies, right? I'm here to expose all of this information for you guys so we can build some trust and some authority on this topic, right? Number one, some people use complex language. All of this is done to confuse the buyers, right? They use terms like riders, cash value, whole life, endowment, exclusions, deductibles. All of these words are intentionally confusing. The more confused you are, the easier it is for them to sell expensive products because you don't understand what they are trying to say. And you are just like, okay, maybe this is how it works. Second thing is, agents often sell policies that pay them. Now, there are different kinds of policies, right? There are lots of different. So, now we will talk about yeah, agencies. Agents often sell policies that pay them, not benefit us. Now, uh, we know that agents earn up to 40 to 60% of the commission of your premium for the first year. So they push the most expensive policy, not the most useful one, because they get paid more. Now, the fifth thing is there's a small print game, right? Companies deny claims. They deny claims using exclusions, misrepresentation clauses, medical non disclosure, late payment, and technical terms. And some companies even avoid legitimate claims. The next thing that happens is that underwriting, which is customers' right to choose which customers, companies' right to choose which customers to object, which customers should we accept. Now, they accept low risk customers where they find that there is lowest risk of them losing. They reject the risky ones and they adjust the premiums to maximize profits. So the company designs the game so they always win. Now, we are going to be talking about part 3, which is specific types of insurance. Now, let us talk about what is life insurance. Whole life insurance is one of the worst financial products sold to publics. Why? Because they have low returns, they have high commissions, they have confusing structure, and many buyers overinsure, right? So, our advice is to buy term insurance and invest in difference. Invest the difference. This applies perfectly in any place. For example, let's talk about health insurance. Companies try to avoid costly customers in health insurance, right? Policies have thousands of exclusions, and claims departments have targets to minimize payouts. So, renewals get more expensive as we age. Let's talk about auto insurance. Auto insurance charges us more than required, uses our credit score, age, and zip code to price you higher, and increase premiums after a single claim. They use the data we never see to classify us as the high risk consumers, right? Right? And then there is property insurance. Many disasters are considered as acts of God, and those are not covered in the property insurance, right? Like acts of God could be a hurricane that happened or fire that happened. Companies pay less than actual repair cost, and we have to prove everything you lost, right? We don't have proof of every single thing that we had in the house, so therefore we don't have the proof of it. We don't have the proof of losing it, and therefore we are not able to prove that we actually lose it, and therefore they use the depreciation to reduce payouts. For example, we lost lots of things in our house fire or in a car accident, and we took a car insurance, but they don't consider the actual price of the car. They consider the price of which was depreciated. Let's talk about part 4, which is how insurance companies how they make big money. Number one thing is premium float, which is Warren Buffett's favorite concept. What is premium float? Insurance companies receive money today and they invest it and then they pay claims much later. This time gap is called as float and it's a gold mine. Even if the company just breaks even on insurance, investment returns make huge profit because of that float, the premium float. Reinsurance. is a secret industry known as reinsurance that so many people don't really know about. Basically, the way it works is that insurance companies insure each other, right? So insurance company take an insurance from other company to insure itself, and that company takes an insurance from other company to insure itself. This spreads risk and hides losses from the public, making the system even more opaque. Third thing is the hidden power, which is actuaries. What is actuarial science? Actuaries are the ones who calculate odds, claims probability, and how to price policies, and how to ensure profit regardless of the market. Actuaries are the real bosses of the insurance industry. The CEOs or the agents are not the real bosses. Real bosses are the actuaries. Now, all of these things help us understand how does insurance work, right? How bad it is, how good it is, how their business operates. Now the question is how to use it properly. Rule number one is insure only what you cannot afford to lose, right? That is rule number one. What are the things that you cannot afford to lose? Life of a breadwinner, right? For example, in your house, there are multiple people. There is a guy who is a breadwinner. He gets us the money. First of all, we need to make sure that we insure his life because he's the breadwinner. Second thing is health. We can't afford to lose health. Invest in health insurance. Major illness. Invest in that. Home. You can't afford to lose a home. Invest in that. Car. You can't afford to lose your car. And yeah, car insurance is mandatory. Income protection is something which is important. You can't afford to lose it. Insure it. Examples to avoid. Mobile insurance should be avoided. Luggage insurance should be avoided. Extended warranties should be avoided. Return to invoice errors should be avoided. Fancy riders should be avoided. These are profit machines for companies. So insure only uh, uh, what you cannot afford to lose. Rule number two, buy term insurance and avoid whole life endowment, right? Whole life and money back policies are designed to make the insurance company rich. And those are also designed to lure more customers, especially the greedy ones. Term insurance, on the other hand, is a pure protection. It's the cheapest one and it's the simplest one. Now, let's talk about Rule 3. Rule 3, when it comes to insurance, is you have to raise deductibles. Higher deductible, which means there is lower premium and there will be better long term savings. This works especially well for auto, health, and home insurance, right? So, if there is a higher deductible, uh, which means there is a lower premium and better long term savings. So, auto, health, home insurance, please take care of it. Let's talk about rule number 4. Shop aggressively. Use multiple companies and compare before buying anything. Never buy the first policy you see. Because when you compare lots of different companies and policies, you actually get to see the differences. And based on that differences, first of all, you start learning more about that thing, you start getting more knowledge about that thing, and then you're able to make the right decision for yourself. Don't buy something that somebody else suggests you. Based on that, that is never the right way to buy the thing, right? We have to use multiple companies and compare before buying anything. Now, let's talk about rule number 5. Read exclusions first, not benefits. So many times when we are buying insurance, our focus is on benefits, and they have designed their benefits in such a way that you will be lured to buy their insurance policy. But the main rule here we need to understand is that we have to read the exclusions first of every single insurance policy that we are planning to buy, not the benefits. Benefits are marketing. Exclusions show the truth. Exclusions is what you need to look at. Rule number 6 is don't claim unnecessarily. Right? Every claim increases next year premium for years. Claim only when the loss is big. That is what you need to learn. If loss is not too big, that's just don't claim it unnecessarily. Rule number 7. In rule 1, we talked about how you should only buy insurance for those things that are actually required. You can't really afford to lose. Rule number 7 is to keep records of those things. Now, since you don't have lots of insurance, you only have the ones that are actually needed. You gotta keep the records of those things, right? During claims, insurers try to find gaps, right? When you're trying to claim anything, they try to find gaps where you cannot really prove that the damage has actually happened. So we gotta keep the bills, photos, receipts, prescriptions, dates, and communication screenshots. All of this help basically help us to basically uh, claim exactly what we deserve. And all of this improves our chances of approval. So let us talk about the part 6, which is the dark side of this insurance. I know that we have discussed a lot of things in this video which were about the dark side, but let's go deeper. Tobias gives shocking case studies in this part. Insurance companies spying on customers is the first one, especially the ones uh, which are really paying really high insurance. They hire private investigators. They delay the payouts until the customer gives up. Hospitals overcharging insured patients is a thing that is very common. Fraud inside companies, that's very common. Adjusters paid bonuses to reduce claims is very common. All of this basically shows that insurance is a giant profit driven machine, not a charity. And that is what you need to understand. That is what is important for you to understand. So, basically, the final message that I want to give you guys from all of these things is that insurance is something which is important, right? But the insurance industry is designed to make money from you, not for you. So, the smartest strategy when it comes to insurance is not that you should not buy insurance because that is just dumb. Smart strategy is buy only essential insurance, avoid all the complex policies, understand what's actually covered, protect yourself from the system by keeping checks and copies and bills of every single thing that you do, and build wealth through investment, not through insurance. Insurance never buy insurance of money back policies and whole life endowment policies. What you need is that if you really want to build wealth, build it through investment, not through insurance. Insurance equals protection, investing equals wealth creation. So never mix the two. That is what you need to understand, right? Now, so many things is what we discussed, right? So let's do a small recap. Insurance companies are basically invisible bankers. Why? Because we give money to them regularly, which is the premium. They invest, earn returns, and grow rich from it. We see nothing, and everything operates behind the doors. They pay out minimum possible, which keeps the system complex and confusing. Part 1, how insurance really works. First of all, it's a gambling business because we always pay, they might pay. They set the rules, we only follow. They win over the long run. And why is this a gambling business? Because you are betting that you will lose, and the company is betting that you will not lose. Second thing is, why are premiums higher? Uh, let's say a company makes so the insurance company makes 55%